On a Tuesday morning in March, the CFO of Vantage Capital Group walked into the building at exactly 8:47 a.m. He swiped his access card, took the elevator to the 14th floor. He poured coffee, then sat down at his desk. His computer was warming up when an email arrived from the audit team. He read it, then read it again. He closed the laptop, stood up, put on his coat, and walked out. Nobody stopped him because nobody thought anything of it. That was the last time anyone at Vantage Capital Group saw Richard Aldrin. The company he left behind was not small. Vantage Capital Group had operated for nearly 2 decades, primarily in the commercial real estate lending space, with a portfolio that stretched across 6 states and included close to $4 billion in managed assets. Not glamorous work by Wall Street standards, but it was solid, predictable. Institutional investors trusted it because nothing exciting ever happened there. Quarterly reports arrived on time. Compliance documents filed without drama. Board meetings were, by all accounts, genuinely boring. Richard Aldrin had been with the company for 11 years by the time he disappeared. He joined as a senior financial analyst, worked his way into the controller role, then was appointed CFO after the previous one retired. He was not the kind of executive who attracted attention. No profiles in business magazines, no speaking engagements. He drove a modest car, lived in a respectable house, and was known among colleagues for 2 things: his precision with numbers and his almost eerie calm. During the 2008 financial crisis, Richard steered Vantage through with minimal losses. The board had praised him publicly. The CEO called him the steadiest hand in the room. That steadiness was part of why his disappearance made so little sense to the people who knew him. There was no argument before he left. No visible signs of stress in the preceding days or weeks. No resignation letter on his desk. No farewell message sent to colleagues. His office was clean. His calendar still had meetings scheduled for the rest of the week. When HR pulled his badge log that afternoon, they found that he had swiped in at 8:47 and swiped out at 9:14. 27 minutes. Whatever happened in that office, in that brief window of time, was enough to make a man with 11 years at a company walk out and not come back. The audit that triggered it had been described internally as routine, and in many ways it was. Every 3 years, Vantage Capital Group contracted an external audit firm to conduct a comprehensive review. The firm brought in for this particular cycle was Carver & Lowe, a mid-sized advisory practice with a solid reputation. They had done work for Vantage once before, about 6 years prior, and everything had gone smoothly. When they arrived in February that year, they were given office space on the 12th floor, access to the company's financial management systems, and a contact list of department heads. Richard Aldrin was their primary contact. For the first 3 weeks, the process was unremarkable. The Carver & Lowe team requested documents in batches, reviewed lending files, cross-referenced balance sheet entries, and sat in on meetings. Their lead auditor, Patricia Soon, later described those early weeks as standard in every way. The documentation was organized, the staff was cooperative. The numbers at first pass appeared to reconcile cleanly. It was sometime in the 4th week that Patricia Soon flagged the first irregularity. It was small, almost invisible within the larger dataset. A series of loan origination fees that had been recorded in the general ledger under a classification that didn't quite match the underlying transaction documentation. The amounts were not large individually. A few $1,000s here, a few thousand there. But the pattern was consistent, and the classification would have had a subtle but real effect on certain expense ratios. Patricia noted it in her working file and requested clarification from Richard's team. The clarification came back promptly. The explanation provided was technical, referencing an internal reclassification policy. The memo attached was professionally formatted and signed by Richard himself. Patricia reviewed it, noted some ambiguity in the language, and flagged a follow-up question. The response this time took 2 days longer than the first. Nobody who observed Richard Aldrin during those weeks would have described him as nervous, but several people later recalled that something had shifted in him. His administrative assistant mentioned that he had started closing his office door more often than usual. A member of the finance team recalled that Richard had begun reviewing certain documents himself rather than delegating to the analysts who normally handled audit requests. A colleague who shared the elevator with him one morning in late February said that Richard had seemed distracted, not stressed exactly, more like someone running calculations in his head that had nothing to do with the conversation happening around him. These are the kinds of details that only become visible in retrospect. Nobody was particularly watching Richard Aldrin. He was a CFO whose company was in the middle of an audit. Some level of engagement was expected. The second irregularity was larger than the first, meaningfully so. Patricia Soon's team traced intercompany transfers. They discovered transactions from an account for which they had no documentation. The account appeared in system logs briefly, then disappeared. It was a pass-through, a temporary clearing mechanism. It moved money between entities, leaving only a faint residue in the system. The money itself was not missing. It landed where it was supposed to. But the path it took was unusual. Documentation explaining that path either didn't exist or hadn't been provided. Patricia escalated the finding to her senior partner at Carver & Lowe. Her partner then requested a meeting with Richard Aldrin. The meeting happened on a Wednesday afternoon, 2 weeks before Richard disappeared. He arrived on time, polite and composed, providing seemingly responsive answers. Richard described the intercompany structure, acknowledging documentation gaps from a system migration. He committed to compiling missing records within 5 business days. He shook hands with Patricia's partner and walked back to his office. The 5 business days passed. The documentation did not arrive. A follow-up email was sent. Then another. Richard responded, but briefly. He promised delivery timelines that kept shifting slightly forward. To Patricia Soon, who had been doing this work for over 15 years, this pattern was not unfamiliar. It didn't necessarily indicate wrongdoing. Audit processes frequently encountered documentation delays, especially at companies that had gone through system changes. But the combination of factors, the fee classification issue, the intercompany transfer path, and now the repeated documentation delays, had moved this audit into a different category in her internal assessment. She began spending more time on Vantage's records than the engagement originally budgeted for. It was during this deeper review that her team found something that none of them had expected. Embedded within the intercompany transaction logs, buried beneath several layers of reclassified entries, were traces of what appeared to be a parallel accounting structure. Not a shadow set of books in the dramatic sense. Something subtler. A series of adjustments made periodically over what appeared to be several years, that had the cumulative effect of shifting certain losses off the primary financial statements and into subsidiary entities that were not consolidated in the investor-facing reports. The amounts, taken together, were not trivial. Patricia's initial estimate put the cumulative effect at somewhere between $40 and $60 million across a period of roughly 4 to 5 years. She was still trying to confirm the full scope of it when Richard Aldrin walked out of the building. The morning Richard disappeared, Patricia Soon's team had submitted a formal document request that was more specific than any of their previous ones. It asked for full transaction records. It also requested the board minutes from a set of quarterly meetings spanning the prior 3 years. The email had been sent the night before and was sitting in Richard's inbox when he arrived at 8:47 that morning. The company's CEO at the time, Gerald Foss, who had led Vantage for 6 years, later said in a deposition that he had received no indication from Richard that anything was wrong. That was technically accurate. What Gerald Foss did not say in that deposition, at least not initially, was that he and Richard had spoken by phone the night before. The call lasted 14 minutes. Its content, Foss maintained, was general in nature, a catch-up conversation. The timing, he acknowledged, was a coincidence. Investigators would spend considerable time on that 14-minute phone call. In the immediate aftermath of Richard's disappearance, the company's first instinct was organizational. The CFO had walked out. The audit was ongoing. Someone needed to manage the situation. An interim CFO was brought in within 48 hours, a consultant named Harlan Drew. He had worked with Vantage in a limited capacity before. The audit team was told that Richard had taken a personal leave of absence due to a family matter. This was the explanation offered internally as well. All future audit inquiries should be directed to Harlan Drew. Patricia soon accepted this explanation with the measured patience of someone who had learned not to accept explanations at face value. She continued her work. She requested the same documents she had requested before. The responses she received from Harlan Drew's team were more complete than what Richard had provided, but they were not complete enough. Certain records that should have existed were described as having been lost. Others were provided in forms that made them difficult to cross-reference with the earlier data. Patricia began to sense, though she could not yet prove
The audit
it,
formally
that she was
concluded 3
working
weeks
later
later
with a qualified opinion
alongside
it, the kind of professional language that signals concern without confirming it. Carver and Lowe identified material weaknesses in internal controls, noted significant documentation gaps, and flagged certain accounting treatments as requiring further scrutiny. The report stopped short of alleging fraud. That was not strictly speaking their role, but the report was detailed enough and careful enough in its language that anyone reading it with knowledge of what Patricia's team had actually found would understand that the qualified opinion was a significant understatement of what the data suggested. The report went to the board. Several board members later claimed they had not fully understood its implications at the time. One board member, a retired banker named Clifford Marsh who had served on the Vantage board for 9 years, later described the meeting at which the audit report was discussed as the most uncomfortable 3 hours of his professional career. He said the questions he asked were not answered directly. He said the CEO's responses were reassuring in tone but thin in substance. He said he had voted, along with the rest of the board, to accept the audit report and commission an internal review rather than immediately escalating to regulators. He said he had spent a significant portion of the years that followed wondering whether that vote had been a mistake. Richard Aldrin, by this point, had been missing for over a month. His family had reported his disappearance to local police. A missing persons report was filed. There was no immediate indication of foul play. His car had been found at the airport parking structure, though no record of him boarding a flight was initially identified. His personal bank accounts showed a withdrawal of $12,000 in cash made 2 days before he disappeared. His passport was gone. Beyond that, the trail was thin. The story at this point quietly receded. Corporate disappearances occasionally make headlines when they involve dramatic accusations or obvious criminality. Richard Aldrin's case was different. It was surrounded by ambiguity. No charges had been filed. No specific accusations had been made publicly. The company described him as being on a personal leave. Local coverage was minimal. Within a few months, the story had largely left public awareness. Vantage Capital Group continued to operate. The internal review that the board had commissioned produced a report that described certain accounting practices as inconsistent with industry standards but stopped well short of the language Patricia Soon's team had used privately. Several adjustments were made to financial reporting procedures. A new CFO was eventually hired. The company kept its institutional investor relationships, though a few of the smaller ones quietly reduced their exposure. From the outside, Vantage looked like a company that had found some process weaknesses, corrected them, and moved on. Years went by. The financial services industry is full of stories like this. Stories that get filed away, that sit in drawer compartments and archived email folders and the memories of people who were told to let things go. Most of those stories stay there, but occasionally something disturbs the sediment. In this case, the disturbance came from an unlikely source. A former junior analyst from Vantage's finance department, a young woman who had been working there during the audit period and had left the company about 8 months after Richard disappeared, had spent the intervening years building a career at a different firm. She was, by the time events resumed, a senior financial analyst at a regional bank. Her name was Mara Tilton, and she had kept something. It was not dramatic what she had kept. It was a USB drive. On that USB drive were copies of certain internal documents she had made during her time at Vantage. Not out of any planned whistleblowing intention, but because she had been working on a specific project during the audit period and had saved copies of files she was analyzing to work on them from home. She had forgotten the drive in a desk drawer after leaving the company. It had moved with her through 2 apartments without being opened. And then, several years later, while reorganizing her home office, she had found it again. What she found on it when she finally plugged it in was not what she had remembered saving. Among the files on the drive were documents she recognized, spreadsheet analyses she had been building, email threads about loan file reviews. But there were also files she did not recognize. A folder that she had no memory of creating, labeled with a sequence of numbers that meant nothing to her. Inside that folder were 3 documents. The first was a spreadsheet. The second was what appeared to be an internal memo. The third was a series of email threads that had apparently been forwarded to her work account automatically as part of a distribution list she had been added to, without being named, during a brief period when the company had been testing a new document management system. Mara Tilton is not someone who acted rashly. She read through the documents carefully over the course of a weekend. Then she called a lawyer. Then she sat on the information for another 3 weeks thinking. Then she called a different lawyer. The documents she had found were significant. The spreadsheet contained what appeared to be a reconciliation between 2 sets of accounts, one that matched the figures in Vantage's investor-facing reports, and another that did not. The variance between them was large, not $40 to $60 million, as Patricia Soon had estimated based on the fragmentary evidence available during the audit. The number in this reconciliation was closer to 90 million. The memo, which appeared to be an internal communication between Richard Aldrin and a name that Mara did not recognizing, an entity identified only as a consulting reference code, described the accounting structure in language that made its purpose clear. The intercompany transfers were not the result of a system migration. They were the result of a deliberate design. Losses from specific loan portfolios had been routed through subsidiary entities that were then excluded from consolidated, reporting through a mechanism that had been constructed carefully enough to pass a surface-level review but was not sustainable under deeper scrutiny. The email threads were perhaps the most significant piece. They showed correspondence between Richard Aldrin and 2 other parties over a period stretching back nearly 6 years. One of those parties was Gerald Foss, the CEO. The emails between Richard and Gerald were elliptical in their language and the kind of careful phrasing that suggests awareness that the words might one day be read by someone other than the intended recipient. But the pattern of communication and certain specific references within it made the nature of the arrangement legible to someone who knew what they were looking at. The second party in the email threads was the one that Patricia Soon had not been able to identify during the audit. An outside advisor, referenced in the documents by a name that would later be identified as a former senior partner at a financial consulting firm who had retired from that firm under circumstances that had never been fully explained. His name was Victor Salame, and his role in the Vantage structure as it emerged from the documents was architectural. He had not created the subsidiary entities. Those had existed for legitimate purposes before his involvement. But he had identified their potential use as a concealment mechanism and had worked with Richard Aldrin to develop the accounting logic that made it function. When the case was eventually reopened, federal investigators moved with the kind of deliberate speed that suggests they had been watching the situation for longer than anyone publicly knew. Mara Tilton's documents were reviewed. Then they were authenticated. Then a grand jury was convened. The process took time. These things always take time. What emerged from it was a picture that was both more complex and more human than the original disappearance had suggested. Richard Aldrin had not designed the structure alone, and he had not designed it primarily for his own benefit. The financial analysis that investigators eventually completed showed that the money concealed within the scheme had not been stolen in the conventional sense. It had been used to manage what was, at its core, a performance problem. Vantage Capital Group's lending portfolio, particularly a segment focused on regional commercial properties, had been underperforming significantly for several years during which the company had been raising new capital from institutional investors based on reported performance figures that did not reflect the true state of the portfolio. Richard had known this. Gerald Foss had known this. The question that investigators and prosecutors would spend considerable time on was how many others had known, and at what level of specificity. Victor Salame's role became clearer as documents were assembled. He had been introduced to Richard through a mutual contact in the financial consulting world and had positioned himself as an expert in intercompany accounting structures for firms operating across multiple regulatory jurisdictions. His advice, at least initially, may have been framed in terms that allowed Richard to tell himself that what he was doing was aggressive accounting rather than fraud. The line between those two things in complex financial structures is sometimes genuinely difficult to locate. But at some point, and the document suggested this point came approximately 18 months into the arrangement, Richard appears to have understood clearly where he stood. The emails from that period changed in character. They became shorter, more guarded. There is one email sent by Richard to Victor Salame at 11:43 p.m. on a Sunday night that reads in its entirety, "This doesn't end well. You know that." Victor Salame's reply, sent the following morning, consisted of 3 sentences discussing an entirely unrelated logistical matter. Whether that was deliberate misdirection or simply a non-response was something investigators debated without reaching a firm conclusion. When Carver and Lowe arrived for the audit, Richard had known for several years that the structure he had helped build was unlikely to survive serious scrutiny. What Patricia soon later found particularly striking, when she reviewed the case materials years later, was how carefully Richard had managed the early weeks of the audit. He had not panicked. He had not attempted to destroy documents, at least not in any way that was ever confirmed. He had responded to requests, provided explanations, pushed back gently on certain lines of inquiry. His behavior, in retrospect, looked less like someone trying to hide something, and more like someone running out of moves in a game they had already decided they could not win. The document request that arrived in his inbox that morning, the one that asked specifically for the subsidiary records and the board minutes, appears to have been the moment he concluded that the end had arrived. Whether he had already prepared for this possibility, or whether the decision to leave was made in those 27 minutes he spent in his office, remains unclear. What is clear is that he did not contact an attorney before he left. He did not attempt to negotiate. He simply left. He was found 3.5 years later living under a different name in a small coastal city in another country. He was not in hiding in any dramatic sense. He had built a quiet life, worked in a modest capacity, and had, by all observable measures, attempted to construct a version of himself that was separated from everything he had left behind. When investigators located him and the relevant legal processes were set in motion, he cooperated. His cooperation was, according to the prosecutors who worked the case, unusually thorough. He described the full history of the structure. He identified documents. He answered questions about Victor Salame and about Gerald Foss. He described the moment. It was during a board presentation in the 3rd year of the arrangement, when he had looked around the room and understood, with complete clarity, that he was the person who would be held responsible if this came apart. Not because he was the architect of the original decision, but because he was the one whose name was on the documents. He described that moment without self-pity. He described it as information, not as an excuse. Gerald Foss, by the time the case came to prosecution, had retired from Vantage Capital Group. His lawyers mounted a defense centered on the argument that he had been misled by Richard Aldrin about the specific nature of the accounting treatments and had relied in good faith on his CFO's representations. This argument was complicated by the email threads that Mara Tilton's drive had preserved. The emails between Richard and Gerald did not show Gerald directing the scheme, but they showed a degree of awareness that made the good faith argument difficult to sustain. Gerald Foss eventually entered a plea agreement. The terms of that agreement were less severe than prosecutors had initially sought, and the reasoning behind that outcome was something that outside observers debated for some time. Victor Salame was more difficult to reach, legally and physically. He had structured his involvement carefully enough that direct criminal liability was challenging to establish. He was never charged. He remains in the public record of this case, a figure who appears in documents and disappears from them without consequence. Patricia Sune, who had by this point moved to a different firm and was working primarily in financial consulting, was contacted by investigators during the reopened inquiry. She provided her original working files, which she had retained in full. She described her interview with investigators as, in her words, satisfying in the narrow sense that it confirmed what she had suspected, and frustrating in the broader sense that it illustrated how much an audit process can approach the truth without being able to reach it. The documentation gaps she had encountered, the delayed responses, the explanations that were technically responsive without being fully honest, none of it had been enough, within the constraints of what an external audit can do, to produce a definitive finding. The audit had identified the shape of something without being able to name it. The institutional investors who had committed capital to Vantage during the relevant period pursued civil litigation. Several of them recovered partial amounts through settlement. None of them recovered their full losses. The legal proceedings, in the way of most complex financial litigation, produced outcomes that were defensible on paper and unsatisfying in reality. Vantage Capital Group itself was restructured. The name eventually disappeared from public filings, absorbed into another entity through a transaction that was, in the manner of such things, described in the accompanying press materials as a strategic combination driven by growth opportunities. What lingers in a case like this is not the legal outcome. The legal outcomes are what they are, calibrated responses to provable facts within the boundaries of what courts can establish. What lingers is the human architecture underneath it all. The decisions that were made, one at a time over a period of years, by people who were not, in most observable ways, villains. Richard Aldrin was a careful, precise man who at some point found himself holding a structure that had grown too large to step away from. Whether the first decision had seemed small enough to justify, or whether he had simply convinced himself that the performance problem was temporary and would correct itself before it mattered. That is not something the legal record captures. Mara Tilton, whose discovery of a forgotten USB drive in a desk drawer eventually broke the case open, went on with her career without significant public attention. She declined most requests for interviews. In the single interview she did give, to a financial news publication, she said that what she had found was disturbing not primarily because of the money involved, but because of the system of ordinary-looking decisions that had produced it. Every individual choice, she said, had probably seemed manageable at the time it was made. That was the part she found difficult to shake. Patricia Soon, in a subsequent professional paper she wrote about the limitations of external audit in detecting structured concealment, made a point that was cited by several subsequent analysts. She noted that the most dangerous financial misrepresentations are not the ones built on lies that look like lies. They are the ones built on partial truths, arranged carefully, that look like the ordinary complexity of large financial organizations. The audit, she wrote, is designed to test for anomalies within a system that is assumed to be operating in good faith. When the system itself has been designed to manage what the audit finds, the gap between what the audit can establish and what is actually true becomes difficult to close. Richard Aldrin, after his cooperation with prosecutors was complete, received a sentence that reflected both the seriousness of the conduct and the credit given for his assistance. He served that sentence. He was, at last report, living quietly. No one from his former professional life has described knowing what he thinks about what he did or how he carried it. He has not, as far as can be determined, spoken publicly about any of it. There is one detail from the investigation that was never fully explained and that investigators acknowledged. In the case summary, remained an open question. Among the documents on Mara Tilton's USB drive, there was a single file that did not fit neatly into the pattern of the others. It was a spreadsheet, formatted differently from the others, with no header information identifying its origin or purpose. It contained a list of numbers, not dollar amounts but what appeared to be reference codes, alongside dates. The dates ranged from several years before the scheme began to approximately 6 months before Richard disappeared. No one interviewed during the investigation was able to confirm what the reference codes represented. Richard Aldrin, when shown the document, said he had no memory of it. Whether that was true or not, no one could establish. It may have been nothing. In a case built on documents and numbers, an unexplained spreadsheet with reference codes and dates is the kind of loose thread that investigations collect and eventually set aside when the main questions have been answered. But it sat in the case file, noted but unresolved, a small remainder of something that had not been accounted for. That is often how these things end. Not with everything explained, but with most things explained. The larger shape of what happened becomes clear, The specific texture of how it felt to live inside it, to make those decisions one at a time over years, to sit in a room with auditors and know what they were getting close to, that part stays out of reach. The documents tell you what happened. They tell you less, and sometimes nothing, about what it meant to the people who made it happen. Richard Aldrin walked out of that building on a Tuesday morning in March and chose disappearance over whatever came next. He had spent 11 years building a reputation for steadiness. He had spent several of those years helping to construct something that would eventually undo that reputation completely. By the time the audit arrived, he had probably understood for a long time that the end was a question of when, not whether. And yet he had continued, not with aggression or confidence. From the picture that emerged with something more like inertia, the weight of what had already been built made stopping harder than continuing. Until the morning, it didn't. What the audit found in the end was not just a set of financial irregularities. It found the outline of a decision made by someone under pressure, repeated until it became a structure, and maintained until the structure became too large to hide. That is not a story unique to Vantage Capital Group. Versions of it have appeared in financial histories across industries and decades, always wearing the ordinary clothing of professional life. The emails, the spreadsheets, the conference calls, the quarterly reports was until something or someone looks closely enough to see what is underneath.